Hi everyone, I'm Brett. Tonight I get the pleasure of covering Social Security, in my opinion the most exciting topic, but I am biased. And really what I want to cover tonight is a lot of the popular questions that we get from clients when they're approaching retirement, Social Security age, and also give you guys some financial planning and maybe tax planning examples that we've run into over the years with clients. So slide one, Social Security misconceptions. I believe the biggest misconception with Social Security is when to claim it. And it's not one size fits all. So just because your friend or coworker might have claimed Social Security at 62 or deferred it, doesn't mean it's right for you. It really comes down to your financial goals and also longevity and health in your family. With Social Security too, I believe you could probably Google when should I take Social Security, and you can find an article that says you should always delay it or always take it as soon as you can. Also in today's day and age with AI, you can probably ask ChatGPT and say, when should I take Social Security, feed it all your information, and it will give you some sort of answer. But really you should be talking to someone who is knowledgeable with Social Security, all the ins and outs and all the nuances before you elect and claim Social Security. Wanted to point out that up to 85% of Social Security benefits may be taxable just at a federal level. You may have heard in the news last year that there was talks about a bill potentially being passed to make Social Security tax-free. Unfortunately, that bill did not pass, but what did pass was the One Big Beautiful Bill in the summer of last year that gave individuals over age 65 an additional $6,000 of standard tax deduction. So that was kind of like their compromise, I guess, with making Social Security quote unquote tax-free, but it is still taxable. Again, 85% of your benefit may be taxable. Social Security is tax exempt from a Michigan state tax level, so there's some benefit there once we do go on Social Security. And how Social Security is calculated for how much of your benefit is taxable, if any at all, is your provisional income. So that's taking your adjusted gross income, or AGI, plus any non-taxable interest, and then adding back in 50% or half of your Social Security benefit. And then how Social Security is calculated. So Social Security takes the highest 35 earnings years of how much you paid into Social Security, and it is inflation adjusted. So if you only paid into Social Security for 30 years, when you go to collect your benefit, you'll only have 30 years taken into consideration, and then those 5 years, they'll have zeros when collecting or calculating your benefit. If you paid in for 40 years, Social Security will take the highest 40. So if you're still working beyond those 35 years paid in, leading up to retirement, those high income earning years, maybe right before you retire, they're going to take those high income earning years and replace it with your lowest income earning year, maybe if you start working 40 years ago. And again, they do adjust it for inflation and bring it back to today's dollars. There's two really big acronyms I want to make sure everyone's aware of when looking at Social Security. The first one is PIA, and that can stand for a different acronym. But for Social Security, it's primary insurance amount. And that's the amount that you'll see on your Social Security statement, how much you're eligible to receive at 62, 63, and 64. That's your primary insurance amount. The other big acronym is full retirement age, FRA, and that depends on what year you were born. So if you're born after 1960, your full retirement age is age 67. If you're born in 1955, it's 66 and 2 months. If you're born in 1956, it's 66 and 4 months, so on and so forth, up to 1959, 66 and 10 months. And why that's important is if you decide to collect Social Security prior to your full retirement age, you just get a permanent reduction in benefits. So it's not a penalty, but you do take less collecting prior to your full retirement age. And then Social Security filing status. So on this slide, I just want to point out the different options that everyone has when collecting Social Security, and there's really three. So you can either file under your own retirement benefit at age 62 under your own earnings record. You could file under an ex-spouse if you were married for at least 10 years and did not remarry prior to age 60, or you could file under a deceased spouse, or what we might call widow benefits. So some examples that we've run into with clients over the years is if you are eligible for a widow benefit, you can take that as early as age 60. And in some cases, it might make sense for a surviving spouse to take their deceased spouse Social Security benefits as soon as they can, maybe at age 60, and then defer their own benefit to age 70. And the reason why you do that is they could then switch to their own retirement benefit at age 70, where it would be the max amount that they'd be eligible to receive. But in the meantime, they're still collecting a widow benefit under their deceased spouse and still having some Social Security income coming into the house during retirement. And then with ex-spouse benefits, we actually ran into this with a client here in the last couple of years. Two clients that were previously divorced and then they were going to remarry. They were going to get married at age 59. We actually told them not to get married at age 59, wait till age 60, so then they could still collect under their former spouse. If they were to get married at age 59, they would have lost that benefit. And they were able to still collect benefit at 60 under a former spouse, and then defer their own benefit to 70 again. So again, just some tips and tricks with Social Security, all the ins and outs and nuances that is really important to know before you decide to collect benefit. And then income limitations with Social Security. So these only apply before your FRA or full retirement age. Again, this is, I think, a popular question that we get, and it's, do my pension or IRA or 401k withdrawals count towards the income limitations with Social Security? And the answer to that is no, it does not count. It's strictly earned income or W-2 wages that Social Security looks at when you're on benefit. So if you're still working at age 62, not collecting benefit, there's no income penalties from Social Security standpoint. It's just when you're on benefit. And that income limit, once we're on Social Security, is $24,480 for 2026. And that is an annual number. One nuance here with Social Security is the first calendar year that we're on benefit, it's actually a monthly test. So if I decide to go on Social Security this year in November, I'm subject to a monthly test for November and December, and it's $2,040 a month, which is just that $24,480 divided by 12. And if I go over by $1, I lose that month of Social Security benefit I have to pay back. So I'm subject to the test for 2 months monthly. Once January hits, it is now an annual number. So I can go out and make 20 grand in January, and I won't be subject to any income limits or penalties from Social Security. But once I do go over that 24,480 number, I lose $1 of Social Security benefit for every 2 that I go over. And the penalties only apply prior to your full retirement age year, but then also once we reach that full retirement age, the dollar amount goes up as to how much we can earn in gross W-2 wages, up to $65,160. And that's just the months leading up to our full retirement age. Once we reach full retirement age, we can go and earn $1 million a year, and there's no income limits as far as Social Security is concerned. And then this is just a financial planning example that I put together that we've run into with clients before. Let's say we have a husband and wife, they're both age 62. The husband is eligible for $2,500 a month in Social Security benefits on his own earnings record. But let's say he's in poor health and he has life expectancy less than 5 years. His wife, on the other hand, is also 62. She can receive $1,200 a month under her own record, and she has good health in her family, and she might live another 30 years because she has longevity. In this example, it might make sense for the husband to defer his own benefit and the wife to collect her own, to have some Social Security income coming into the house, because in the event that one spouse passes away, the surviving spouse only receives the greater of the 2 benefits. They don't receive both. So let's say the husband passes away at age 65, and at this point he deferred his benefit. It's now $2,900 a month. The wife would then be able to step into and receive a higher Social Security payout. She wouldn't get exactly the $2,900 a month. It would be slightly reduced because she'd be stepping in at age 65, so maybe she receives $2,800 a month or $2,700 a month, but there still would be a step up in income that she would be receiving at the passing of the first spouse in this example. And then kind of how we would tie things back into our office with financial planning is we believe everyone should go through a financial plan. And how we view Social Security in our office is taking everyone through a financial plan, looking at all the options that you have available to you, and looking at the financial plan using our software, looking at your goals, financial profile, and just seeing longevity, what's the break even if we do decide to defer Social Security. Another thing to look at too that I'm actually working with a client with from last year was I had a client retire and received a severance package from his employer. And what we're doing this year, and I think possibly next year moving into 27 and 28, is we're gonna have him defer Social Security and his pension and live on the money that he was given from his employer as a severance. So he's gonna show next to no income for the year, and we're gonna take advantage of a low income tax bracket, convert money from IRA to Roth, max out the 12% bracket. And once he collects Social Security and his pension, he'll be well into the 22. So it's kind of a tax planning example that, again, we wanna make sure we're aware of before we go in and collect Social Security. I think that's everything on my end. Sharon's gonna come up and talk about health insurance.